Hi, it's Nash from AlphaFi. Please smash that like button, hit the subscribe. It would mean a lot so you don't miss anything that I post in the future. So today I'm going to go over the product guide, and this covers multiple companies and kind of gives you a guide as to different whole life products and their names and what they mean. So let's dive in. So the first category I have here is product type traditional. And what I mean by traditional is these are generally the whole life products called the 121 or 199 or the higher number. And what these numbers mean exactly is that you have a premium paying period for that amount of time. So say you're 50 years old. That would mean premiums, level premiums, that's one guaranteed component of whole life. Those level premiums are payable from age 50 up until age 121, 199. Now you'd say, okay, well, I'm not going to live to age 121, that's true, but that is essentially what's going on. And they're amortizing the payments over that long amount of time, which essentially makes it so that the death benefit compared to the base premium is higher. Or another way to say that is the death benefit's higher for a lower base premium as compared to other products. So these products are general whole life or traditional whole life that you may see where somebody is really just doing all base premium and they're looking for the highest death benefit at the lowest cost or lowest premium amount. So this can be quite beneficial if you're looking at smaller policies and really want to squeeze down that base premium but still maximize the amount going into policy into PUAs. This can offer a lower minimum premium because there is a minimum amount of whole life that you can take out, and so that will be the minimum amount of whole life premium. You certainly don't have to pay until you're age 121, 199, but that's how they amortize the payments. If you elect not to pay anymore through an option called a reduced paid up, then your death benefit would come down for however much that you've actually put into the policy based on that amortization schedule. The next product type is called the high early cash value, and there is actually a MassMutual product called the HECV or high early cash value. So HECV stands for high early cash value. Alright, so there's the high early cash value, which is exactly what it says. It generates very high early cash values, and the way they do that, it's not some magic, but they actually spread they spread the fees out on the policy over multiple years. So that gives a higher liquidity or crediting rate back to cash value in early years. The drawback is that you'll see lagging performance when comparing to some of the higher cash value policies in comparison. So that's the trade-off there. I will say the executive strategies, which I have some videos on, actually has very high early cash values and doesn't actually impact the long-term performance as much as the MassMutual high early cash value product. But anyways, these ones are specifically for generating high early cash value up to 90-95%, for example, of your money that you funded in coming back to cash value in early years, or I should say year one, and then more so in earlier years. Okay, hybrid products. So the Guardian L95 is kind of a hybrid product. It gets kind of the best of both worlds. It has high early cash value crediting rate. It also has very good flexibility and a pretty decent death benefit amount. This is used a lot in some of my designs because of the flexible nature and kind of the best of both worlds for early cash value as well as long-term performance. And then lastly, limited pay products. So you might recognize some of these names like a 10 pay, a 12 pay, a 15 pay, a whole life 65. So again, with the numbers here, what they're saying is that you can pay for a limited amount of time. So 10 years you can pay into the policy with those premiums, 12 years, 15 years, or until age on this one 65. So it depends on the time frame depending upon your age when you take out the policy. And I will add that the whole life 95, same methodology applies. You can pay from current age until you're age 95. So these limited pay products, They have limited paying periods. That could be a benefit or a drawback depending on kind of your goals and your cash flow and desire for how long to fund into these policies. You build cash value more quickly, so another way to say that is there's a higher crediting rate to cash value on base premium dollars, so that's actually a big plus. And generally you have a lower death benefit. So what I mean to say is that if you're paying for 10 years, so that amortization schedule of payments as opposed to the whole life 121, which would be a tremendous amount of time depending upon your age, right? So let's just say age 50. A 10-pay product would be paying from age 50 to age 60, 10 years. Same with age 40, 40 to 50, 10 years, and so on. But if you're 50 and you have a whole life 121, if you did live that long, you would pay for 71 years, or you would have the ability to do so, rather. So anyways, the less amount of payments is going to give you a lower death benefit, because they're not assuming you're paying for any more than 10 years, because that's actually a product limitation. So it could be a benefit, it could be a drawback depending upon your goals. One way, I mean, these are really quite good cash value products if you don't want to pay for more than these amount of years. One thing that they have actually shown to be quite useful in is that if you want to fund in, let's say, $100,000 per year, comparing, let's say, the whole life 95 versus a 10-pay, the death benefit on the whole life 95 is going to be quite a bit higher than the 10-pay. And death benefit qualification as part of the underwriting process is important, and they're essentially underwriting and approving you as the policyholder or the applicant for a given amount of death benefit, given your lifetime value and earning potential. And so if that is a limitation and they did not approve you for the amount of death benefit you want on a whole life 95 and it was less, then a 10-pay product may allow you to still fund in the desired amount that the L95 wouldn't have, given the death benefit limitations, given that you don't require as high of a death benefit for these limited pay products. So this is the overview or product guide for whole life insurance. One of the very important things when selecting a policy, I always say company is number one. You really want to work with a great company with a proven track record of performance of delivering cash value growth over time, not just an illustrated value, but actually proven performance over the test of time. And so we always recommend the 4 major mutual companies: Guardian, Mass Mutual, New York Life, and Northwestern Mutual, because they've proven to deliver that 4 to 6% net IRR on cash value growth over the test of time. Second is, what's the product that you're choosing? And there's different pros and cons for the products, which we covered in detail today. Number 3 is the design. So certainly this is a product overview, but all my other videos are very big on where is your money going, because base premium compared to PUA contributions makes a big deal. I'm a big proponent of 10% of your money or less going to base premium, 90% or more going to PUAs to generate really high early cash values for you, strong guarantees, and really strong short and long-term performance for you. So design comes with also agent selection, somebody who's transparent, education, going to answer all your questions and show you different options. So that's what I would recommend when diving in and looking at practicing infinite banking or looking at high cash value whole life insurance to enhance your legacy and build your wealth and assets. Alright, I hope this was helpful. Let me know if you have any questions, drop them in the chat, and I'll talk to you soon. Thanks. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.